Discussion today. My name is Martin Rhymes. We're going to talk about trend and momentum trading. I'm going to give you something today that you can immediately start testing, okay? Let me just get this set up for the presentation. Okay. So again, I want to thank you for being here. I'm going to start, rather than wait for some people to show up, I'm going to start immediately. Now, I'd like to thank AgenaTrader. Thank you very much. Your commitment to trader education is greatly appreciated. Now, what we're going to do is I'm going to give you an idea of how to trade trend and momentum. And then we're going to talk about how we've got this available on the Agena platform. Okay, so it's kind of like a trading assistant helping you. But even if you do not wish to use the add-on, what I'm telling you today will provide specific entry, specific protective stop, and a trailing stop suggestion. Okay, so you're going to have immediate ideas for testing. Now, don't worry, I'm going to show you some charts, okay? Seeing is believing. Remember that we are adults here, and trading financial instruments using contract stocks or options is extremely risky. So only trade with money you can afford to lose. I should say, place at risk. Past results do not guarantee future results. Also, you might consider consulting a licensed professional prior to trading. Use real money. And remember, paper trade to learn any new concepts. Paper trade regardless of your level of expertise. And this was brought home to me by a mentor of mine who had traded for 50 years. He also had traded a hedge fund, futures hedge fund. And anytime he caught wind of a new idea, he paper traded, okay? So it's not just total new beginners that need to paper trade. Respect the power of leverage when you trade futures. Now, briefly, I've been doing this business for over 25 years. I started teaching with a newsletter I sent out in 2008. In 2013, people said, you know what, can you do a nightly video format? So, okay, I changed. And now what I do is Monday through Thursday, I will present a newsletter, a nightly market update, and I'll have at least one video a week. Depending on what the market is doing, we may have more than one. Or maybe I'll just send charts with trade suggestions. But this is an absolute beautiful way to follow the market at the end of the right edge of the chart. Now, I do about 4 total immersion boot camps. That's for position trading. Just day trade is a total immersion intensive that I use to talk about, you know, day trading with trend and momentum. In fact, today's lesson comes from that course. We just held this recently in May, and I have the recordings available. Everything I do will work on stocks, options, bonds, futures, forex. That's why it is so robust, very robust. Now, just so you know, I've got various indicators experience. I've settled on one, which we're going to talk about. And I've spoken at trading conferences and provided numerous webinars for traders. I promote a relaxed, simplified method of trading. Now, this is me. And that is, if you see the background, those are orchids. I've got about, I don't know, 300 to 500 orchids. And this is my trading room at the house, okay? And you don't need 5 monitors. I've got 5 monitors and 2 computers. I just like it. So, just a reminder, I created Hit the Mark Trading because I felt like there was a total lack of straightforward trading methods. So my main message to you is keep your day trading simplified. This is my goal, whether day trading or position trading. Simple works. And always remember that day trading is the most demanding. So you must keep your trading simple so that you can react. And by the way, if you have any questions during this presentation, please hold them to the end and I will certainly answer every question. Now, in everything we do, we look at the charts with an all-encompassing point of view. That's price action, trend and momentum, a price oscillator, and market linkages, which are very important. I cover some of the stuff in Rooster Call, which is a morning client letter. If you would like to receive this, in fact, I post it to once or twice a week. I will post this to the Agena Facebook page, but you can have it delivered free for 30 days. No type of credit card required. Just send me a note, martin@hitthemarktrading.com, or you can sign it up on my webpage. Now let's just show you how to do that. So you go to hitthemarktrading.com, go to contact, and this is where you sign into Rooster Call, okay? Very, very, very easy. Okay. And if you're interested in the Just Day Trade, I have not changed this, but if you were to go to Just Day Trade, we actually held this, of course, May 15th through the 17th, and we have recordings available if you're interested. Now, this is an absolute, total, intensive learning experience. Very good. Okay. Let's get on with our presentation. Now, we're going to talk about the Rhymes Range Bar Sniper package, as well as just one of the patterns we use. What I like about mentioning the add-on is that it puts the power of a semi-automated trading strategy in your hands. Semi-automated means that you are the person who decides whether to take the trade. You're not just sitting there, the computer fires off trades and you wonder what's going to happen. You're actually looking at the setups and then you decide yes or no. I don't want to take it, I do want to take it. So all the charts I created with AgenaTrader. I do use range bars, but the methodology is robust for use on any time frame chart, whether you're using tick, volume, Renko, time charts, anything. All we ask for in day trading is momentum and a trading range. So I always ask the question, what if you had a trading assistant? What if your trading assistant monitors the market and calls out setups? And what if all you had to do was scan the suggested setup and either agree or disagree? So the question is, would your trading become more relaxed and could you let the market come to you? Well, now we're talking about the Rhymes Range Bar Sniper package. Put the power of semi-automated trading into your hands. Now, use of a trailing stop will use a logic of a larger initial stop when you first place the trade, followed by tightening of the protective stop as the trade moves in the intended direction. Okay, I'll get into that. Basically, with this trading assistant, we're going to monitor multiple markets, monitor multiple time frames if you would like. The software simply scans the signals. I've built into this 16 criteria checked. So if the criteria are all checked, orders are preloaded when the conditions are met. Your entry, your exit, your trailing stop is all done for you. Above all, you are the trader in command. It gets better. If you desire, you can have your assistant automatically size your orders. So let's just say you have an account, and I'm just going to throw a number out. Let's say you've got $10,000 in your account, and you can tell the software package, Agena, how much you want to allocate. And you can say, if I make $1,500, add a contract. If I lose $1,000, take a contract off, or whatever parameters you want. Now, when you talk about this type of trading, now you're entering into the professional realm. So all this is according to your account size and your risk tolerance. You're simply left to trade the markets. Okay? So you've got now a money management back office. The money management back office is taking care of the details that you have predefined. So all you have to do now is find moving markets. What if you wanted to, have your back office set up to where, I don't know, every time you make $5,000, you add a contract. If you lose $2,000, you take one off. Well, suddenly what you're trying to do is you're trying to conserve your wins, aren't you? Right? There's a myriad of possibilities here. This is what puts you in the realm of trading more professionally and less emotion driven. Okay. Now, they do have a 14-day trial. And if you don't like it at the end of 14 days, you just ask for the refund. You can either purchase it outright, which is cheaper, or you can rent the add-on. I suggest you run your test, extensively test. What you gain is a quiet confidence. Wash, rinse, repeat, just like the professionals. Now, what is momentum trading? Momentum trading is the art of spotting a market ready to move, selecting a trade, entering the trade with confidence, and utilizing predetermined exit points. Momentum trading builds off a firm understanding of support and resistance, along with known areas price is attracted toward moving. What we're talking about is trading directionally, up or down, riding the price wave rather than reacting to what might happen. And this is usually accompanied by a price oscillator. And we're using a price oscillator for intraday or even short-term trading, holding over a few days or weeks. Today we're going to talk about day trading. So in day trading, we're going to use the daily chart for our big picture. We'll use a short-term chart for tactical entries. So as a general rule, the more volatile the market, the smaller the time frame. Got it? Unless, now there's a big caveat, unless the markets are just whippy and too much noise, then what do? Expand the time and you will get rid of some of that noise. And I'll delve into this later in the presentation. We know that markets move up, down, and sideways, and if a market is sideways, we are greatly challenged unless the range is large. It is imperative to find moving markets. And what this means is some people who pride themselves, hey, I only trade ES futures, those kind of people must expand their horizon at time to other futures showing movement. Now, oscillators derive their power from price movement, and for this reason, you really need to understand how to read price action at support and resistance areas. The oscillator then provides a trigger point for entry. So, as a great example, when I teach just day trade, the entire first hour may seem redundant because we don't use any type of indicator, anything. I'm building a foundation. Understand what price does, because that's your job, especially as a day trader. You know, the position traders can worry about supply and demand, commitment of traders report, seasonality, blah, blah, blah. But the day trader has to be able to understand price movement, especially between support and resistance areas. Now, people look at the oscillators out there and they just get overwhelmed. And then people develop an emotional attachment to an oscillator. And so here's what a lot of people use or look like. I don't know if you're familiar with the story of the 6 blind men, and they each felt a different part of the elephant, and they were absolutely sure of what they were feeling, right? They were absolutely sure based on what small little area of the elephant they felt. Well, if you just substitute the trading market for elephant, you're going to find the same thing. There will be people, and they are so enamored with MACD. And they're going to say, oh, MACD's everything. I've got this MACD. It just, it tells me everything I need to know about the market. Or this guy holding the tusk here. Well, okay, RSI, you can't beat RSI. This guy holding the ear. Well, if it was a person trading, they might say, well, percent R. All I need is percent R. Then you got someone saying, no, Bollinger Bands. Buy at the bottom, sell at the top. What could be simpler? Then you get the guys who say, look, I laid out a lot of money for an expensive proprietary indicator. It has to work the best because it costs so much, right? That's the logic of that, right? Then you got a guy down here, maybe he says, well, you know what? I like slow stochastics. So what's my point here? Tons of oscillators exist. I'm telling you, hundreds. And everyone who invents these oscillators believes it is the latest and the greatest. So what's hot now? Market profile. Ooh, super hot. Everyone has their personal favorite. Now, when I was first starting out position trading, I used stochastics, MACD, Williams percent R, RSI. I probably had the Bollinger Bands. And you know what? For position trading where you are analyzing at night when the markets are closed, you can do this. You can put 12 indicators if you want. And the funny thing happens is you realize, wow, they all kind of move at the same time. So at present, I use one indicator after years of trading and my desire to simplify. So I use the Commodity Channel Index. It's also called the CCI. Let's have a very strong understanding, and I'm going to tell you something here that you will not hear anywhere else, okay? I'm going to be totally honest with you. In a strong momentum market, all price oscillators work. Everything works. In a strong momentum market, the folks selling expensive proprietary indicators are going to be shouting, look at what we did today. And those same people are so quiet if the market is in tight range, because in a tight range market, all price oscillators will lose their predictive value. And I'm telling you, all of them. So this is one more reason that you really need to monitor several markets looking for momentum. You know, the very first market I ever traded, day trading, was cocoa. Why cocoa? Well, because it moved. Okay, what is CCI? It's an price oscillator created by a gentleman named Donald Lambert. I met Mr. Lambert. Basically, in a moving market, the CCI is shown to lead price. Now, don't take my word for it. Check out John Murphy's word in his book, Technical Analysis of the Financial Market. And by the way, if anyone desires to become a chartered market technician, this book is required reading. Now, he only spends maybe half a page on the CCI because he talks about everything. But here's what I want to highlight for you. Those are directly from his book. Notice that the CCI turns before, got that word? Before prices at each top and bottom. So what he's saying is, hey, here's the top. Look at the CCI. Hey, here's the bottom. Look at the CCI. Now, one thing about getting in ahead of the game is what? Using momentum. It's when it's like throwing an apple in the air. You throw the apple up, it goes up, 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 up. Good, strong momentum. Then it kind of reaches a point where it doesn't do anything. And then it slowly comes down, right? So if your indicator measuring momentum is getting you in early, there's a chance, of course, it can get you out early. That's part of the trade-off. But that's okay because we can always get back in. We can always get back in. Never, ever worry about getting into a market. Now, the CCI is a price oscillator. All you need to know is that we're comparing a price with a simple moving average over a selected time span. Mr. Lambert suggested 20, a 20 time span. So, for example, on daily charts, he's using a 20-day period. If you're using for day trading, we're going to adjust the setting. We're going to adjust the setting to 14. Now, what this means is suddenly, if we're using a 5-minute chart, what are we doing? We're going to use the CCI based on 14 5-minute bars. Okay. So, intraday use, adjust from 20, which is the default on every single chart package, adjust it to 14. You want smaller time frames in moving markets with good range, and try to find out if the instrument you trade has a rush hour, which used to be pretty easier on equity index futures. The rush hour was from 9:45 to say 11:30. So let's talk about reading the histogram. This is a gold chart, 5-minute. Now this is an older chart. I'm going to show you today's charts. But right now, let's just focus on how to read the histogram. So here we have the 0 line, okay? And what we say is if you have 5 to 6 bars above the 0 line, then we have a CCI bias to the upside. 5 to 6 bars below the 0 line. Whoops, about like that. And we have a downward bias on the CCI, okay? Absolutely. We have the plus 100, that's red, that's this line. We have the plus 150, that's the blue line. And the gold line here at the top is 200. We call that extremes because it's rarely hit and it's rarely going to stay there long. On the downside, we have minus 100, minus 150, and then we'd have minus 200. What do these lines represent? They represent, on the histogram, minor support and resistance. Therefore, If I'm crossing above the 100, I'm breaking through minor resistance, which serves as what? An indication of strength. Okay, good. Now, how do you calculate the CCI? This always comes up with engineering type people or airline pilots or doctors. They want to know, how do I calculate it? Well, I'm going to give you the formula, but your software has this automated. All you define is the period. Now, I'll let you study this. You can freeze the video recording and study this. I don't think you need to worry about it, okay? It's all done for you. And remember, anywhere you see 20 for day trading is going to be 14. You will use 14 all the way up until you get to 60 minutes. 60 minutes and above, you use 20. What I would like to position here in your mind is that if you want to succeed at day trading, let's have an understanding. With this methodology, we are visual traders. CCI is plotted on a histogram. Zero line represents major support and resistance. 150 lines, 100 and 150 lines, or minus 100 and minus 150, represent minor support and resistance, okay? And that's all we do. We look at this thing and say, my gosh, one look at the histogram and I have a bias. And it's very, very, very robust, okay? Now, I'm going to talk to you about, this is a freebie for you, totally free. If you make a commitment that you're going to test what I'm fixing to tell you now, you're going to be shocked at the improvement in your trading. And I mean that. This is my way of giving back. So we're going to talk about the diagonal trendline break. You know, I lived in Asia for about 5 years. And the word auspicious, very commonly used. Something is auspicious. I call the diagonal trendline break auspicious because it's so unbelievably powerful. The rule is we're going to start drawing from plus or minus 150 line. This is a very simple concept. Simple works, and the diagonal trendline break is a wonderful tool. Let's go to the live charts. Here we go. Boom. Bring forth the charts. All right. So what we're going to do, this is the YM. We're going to look and say, are we at 150 or higher? Yeah, that's right here. Okay. Draw a diagonal trend line. Okay. So I draw one right here. I'm touching it here. I'm touching the CCI here. I get a break, and then I can even draw another one here if I'd like. So now let's look at the results. Oh, I don't have a vertical, so I need to get a vertical. So here's one. This says, okay, go along. Gee, that didn't work, did it? Is there anything else we could do? Oh, of course I've got something else I use. What about this? Called it pretty well, didn't it? Up we go, boom. And by the way, I just put on these charts recently. These are your swing. I'm just kind of testing that on my own now. These are swing lines, the green lines. In other words, price goes up, so falls back, it draws a line. Let's do another one now. Take a look at this area right here. Let me get my pen. Come on, pen, where are you? We're at 150, right? Minus 150, okay. That's a key requirement. Now let's take our trend line, whoops. Draw the line. Oh, not you, buddy. I hit the wrong tool. Too many tools. Just a moment. Draw it. Now we have diagonal trendline break. Where would that be? Whoops. I really need to put that down easy where I can access it. But I only use it for teaching. Whoops, there's your diagonal trendline break. It says go short. Now notice my sell signal on the automated program is right here. So that tells me there was something else that did not, something else said, wait a minute. And it might have been because I don't like to take a trade in a range of $200 or less, okay? I don't. You get chopped up. And that's likely what happened here. But as far as just the idea of how does this diagonal trend line break work, I think you see. Now let's look at something else. Here's a trend line. Start at 150 or higher, yeah. Notice that I touch here and just extend it down. Now suddenly I have a buy signal. Where's the buy signal? Right here. And this says price should go up. Did it? Yep. Now, when you look at this, look at the ES over here. By the way, this is a 10 range bar ES. And this is a 15 range bar YM. When you see that this market is so unbelievably tight, okay? So the range is quite, it's quite tight. It's just what I drew here is like $266, I think. When I see that tight, I'm scared of it. Because I know that by the time I enter, it's going to go against me. So I just keep a hard, fast rule. If it's $200 or less, or $220, $225, I'm not interested. I'm sorry, I'm just not interested. Because by the time you enter, they will cut you up. And what we find is Mondays, as a general rule, Mondays are slow in equity index futures. Friday in the summer is notorious slow for equity index futures. On this particular program, anytime that I get multiple signals, it's like a battering ram. So there's one, there's two, there's three. So I'm being told that the underlying power of the market wants to go higher. But it's also just telling me, hey, I'm sideways. So I need to let price really resolve this issue. So what do you do if you got these kind of markets? Well, the NQ tends to run, okay? Absolutely. And we got that here. So let's just look at the NQ. All right, now we were not quite at the 150 line here, so it's your decision or not whether you want to say, well, that's close enough. There is another pattern in here. I don't want to confuse you. There is another pattern that would tell us to go long here. And what did I tell you earlier about these? These are your signals, okay? Saying the underlying power of the market wants to move higher. And lo and behold, boom. And here's your diagonal trend line break, right? It meets the rule, doesn't it? 150, Down we go. So where's the buy? Where's the buy? Boom. How sweet is that? How much is that worth? Well, right there is $263. Well, then, if markets are so tight here, what else can we do? Well, let's think about this. What about gold? And by the way, when is the worst time for equity index futures? Bar none. When is the absolute worst time for equity index futures? Always the first 2 weeks of August. But what's moving? Gold's moving in August. What else? Crude's moving in August. Just remember that. You might want to write that down. You're probably going to lose first 2 weeks in August in equity index futures. Europe's on vacation. USA's on vacation. Okay, so what we have here is the idea. Please come. What are we doing here now? I'm going to move this guy. Okay. There. This is well, that's May 34, May 31. Okay. Here we are over here. Here's today's trading. Now that's the first Friday. Okay. Here's 3 o'clock in the morning. The European and the Asian traders, they love to move these markets when the Americans are asleep. Okay. Now this, one of the things I teach are these trend lines. So this is all from last week, and we simply extend it out, and look how price respected it. Price respected it, right? Amazing, just amazing. But this is gold. Let's try crude. August gold. All right, here's crude. Here's today at 10:03. Now this is what we call an absolutely beautiful signal. And you know, you need to know something about your instrument, don't you? So what is the value of this trade? Let's say you saw that and you decide to take it. Well, let's just say down to here. That's 412 bucks. Now for some people that's enough. But some people want to use runners. Okay, great. So maybe they got out here. Super, that's 650. There's no other signal because the machine assumes you're short. Some people want to go longer with a runner. That's fine. So let's suppose they got out here. Now we're talking about, I think that's $865. So wouldn't it be great to trail and capture all of this? Well, that's why we have a built-in trailing system. Okay. So this red line is going to keep us in the trade. We can define this, by the way. It keeps us until right here and takes the profit. Did you get a signal to go long? I mean, to go short again? Yes, absolutely. Where is it? I don't see the arrow. Okay, well, as a discretionary trader, it's right here. And did we go lower? Absolutely we did. Where's your stop? If you're trailing it, it's the red line. And you're in the trade until until right here. You're out of it. Maybe some people use just, maybe some people want to use targets. That's fine too. Now, let me get rid of this blue thing. The blue box, what the heck is the blue box? The blue box is an area that I have previously identified as an area price likes to gravitate toward. And guess what? It did. Okay, so I hope that I've shown you how to use the diagonal trendline break. Here's another one. Let's look at another one. Okay, diagonal trendline break. This one right here, it looks like it didn't work, did it? Now, do we have filters that keep us in and out of this stuff? Sure we do. But just the act of drawing these diagonal trendline breaks is going to be a huge eye-opener. Huge. Because it is so robust. Okay? All right, let's go back to their presentation. Now, one moment. There are 4 other CCI patterns I use and teach, along with other robust setups, filters, and nuances. But 50% of the trades are accomplished with the diagonal trendline break. Now, I have to tell you, I am the greatest skeptic in the world. So for 1 year, I traded, and at the end of the day, printed off a black and white chart of the 3-minute Russell 2000, back when it was called the ER2. And I took pencil and ruler and said, well, if I entered at this point and exit at this point, did it work? And this made me a believer. So yours free today. Remember, we're going to draw our trend lines at plus or minus 100. Better trades are in markets showing momentum. You're going to use a 14 CCI for intraday below 60 minutes. So we talked about diagonal trend line break with the trend. Draw it from plus or minus 150 line. Use confirmation price bar close if you want, and if you're using a smaller time frame chart. That means you get a signal, but you let that bar, another bar print, just to confirm, yes, it wants to go. That's your choice. If the trend is super strong, you want to just get in there. And we do have method of measuring a super strong trend. I suggest you counter trend only after you have mastered trend trading. There is a reason why they say the trend is your friend. Now the protective stop rule, this is your initial protective stop. If you're going to go long, you're going to place your stop either below the trigger price bar, where you got your signal, or a prior price bar to the trigger. Whoever is lower. And what that means is, draw something here. Let's say that this is my trigger bar, okay? Who's lower? And then price starts going. Where does the stop go? Initial is going to be below the bar prior to the trigger because he's lower. I want to emphasize initial because this is going to be about, on a 10 range bar chart, on something that moves 10 bucks, that's going to be probably about a $200 stop. Some people shudder at that. But it works to keep you in and not get knocked out by any kind of noise. It works, but you have to make it work for you. You can't just take my word. You have to practice. You've got to see it and internalize it. What if your setup was like this? Where this is the trigger. Where's the stop go? Well, if this is the prior, it looks like the trigger bar is lower, so your stop is going to go just under there. And you will see that just like I've shown in this diagram, using this kind of stop, more often than not, high degree, is going to keep you into the trade. The danger is if price suddenly goes sideways, and then price just whips back and forth. And so sometimes, yes, you get stopped out. And if you see it's moving sideways, you better let price resolve the issue rather than you try to guess. Forget guessing. All right, good. All right. So, my goodness. Remember that this blue and red, these blue and red lines, these are the trailing stops, okay? These are the trailing stops. Let's try to focus on this area right here. The blue line shows our signal. Let me just get my pen. So the stop is just under here, okay? Because the red line has a higher close. So your stop is just under here. Wait, I'm sorry. The trigger was actually this one. Forget that. Don't want to confuse you. Here's the trigger. The bar in front of the trigger is lower, so that means the stop must be here. And then you trail. So as price moves in your intended expected direction, you are trailing along. So suddenly you don't have a $200 or $225 protective stop anymore. Suddenly you're trailing the market. The key is what? We want momentum. We want movement. We want range. 2017 was notorious for tight range trading almost the entire year. Tough, very tough for equity index futures. Now what's this right here? 150, yeah, draw that line, whoops. Sell signal. Now that's counter trend, isn't it? Well, the red tells you, hey, if you got the red showing, I expect that we're going to be going lower, right? Our signal didn't show up until here. It was just, remember, there's 16 criteria, okay, that he's looking at to make this higher probability. If you're just simply following diagonal trendline break, hey, this worked. So you got a signal here that worked? Yes. Got a signal here that worked? Yes. What more can you ask for? Simple. Keep it simple. Keep it simple. People are afraid of simplicity. You know that? But in the professionals that I talk to, they all work with simple stuff. Very simple. Now, I've come to the belief at this point in my trading life that entries are easy. Entries are the easiest thing you can possibly do. But for new people, entry is a sweaty palms. Entries, they are absolutely petrified of entry. What if I'm wrong? What if I'm wrong? Well, the longer you trade, the more you find out that entries are simply a dime a dozen. They really are. They really are. The hardest aspect of trading are exits, because exits now bring into the game your emotional connection to money. So some people find that the best thing for them to do is work with profit targets. There's nothing wrong with working with profit targets. If you take a profit target and you make $80 and the market moves $500, guess what? You still went to the bank. There's nothing wrong with profit targets. Of course, you can use runners. That means take some off and then let the thing run. The people who like to take profit targets are people who like to be consistent rather than guessing, oh, well, maybe this is the run of the century. The people who are taking profits want consistency, and they're happy. Regardless of how something moves in the day, if they are consistent with their profit taking and they're using the momentum indicator, they understand the secret is not winning big. The secret is winning small and winning often. And then they attempt to string together a series of short duration, high profit trades. But some people have an ego and say, no, I want to be able to say, I caught this big, huge move. So you have to decide what kind of person you are. If you want to use CCI for a technical exit, just understand that if the CCI started turning at the 150 line, crossing back towards 0 line, you're being told, hey, momentum might be leaving the party. CCI crosses the 100 line, you probably need to get out of the trade. You can always get back in. The trailing stop use can capture greater gains, providing the market's going to give greater gains. Now, everything I've told you is robust, used across any instrument, across any chart time frame. If an action repeats, we can trade it. Day trading, I think you should use activity-based bars rather than time charts. Okay? Remember, I'm not interested in taking a trade if the range is between, say, 200, 250. I've learned the hard way. By the time you enter, they turn it around. So I let price resolve the issue. Meanwhile, oscillators or moving averages are chopping you up. And the big boys, the people who create volume, let's have an understanding. Those guys are masters. They'll throw in fake orders. People watching the dome get excited. Then they pull the orders. So wait for the price bar to print. Let price resolve the chop. Okay? Also remember, if you were to tell your broker, hey, take me out if I am down $1,000. Unfortunately, this is more of a suggestion. Most of the time, the broker can do this. But in a fast market, like a news event, I'm sorry, but if the market is too fast, these broker-imposed limits, you know, you're going to get the statement says you lost $1,200. You call the broker and he says, look, the market was just too fast. And when you sign to trade electronically, you agree to this. So just understand that. So I'm gonna skip this other stuff because I want to see if there's any questions. The way they've got this set up, it'll automatically shut me off after 1 hour. So are there any questions? And if you have any questions, you can certainly write me, and you can write me at martin@hitmarktrading.com. Okay, let me write that in the chat. Okay, well, I don't see any questions. Okay, good. Perhaps I've been very thorough. Super. If you have any questions, just write me. Let me thank you for your attention. If you're not using Agena, okay, then go to my website, go to the go to the Clients and Resources page, and you'll find a link for Agena. Okay? And with this link on Agena, you can be taken directly to the Rhymes Range Bar Sniper or the Agena software, okay? Very good. I appreciate your attendance, and I'll talk to you later. Bye-bye now.